In tonight's Business Insider, the stock market gained steam. Over the weekend, OPEC, the Organization of Petroleum Exporting Countries, failed to reach an agreement to cap output. But the price of oil recovered from an early slide. The market followed. For more, I'm joined by Jason Howell, Family Wealth Advisor at Jason Howell Company. All right, Jason, this is such a fickle sector. OPEC fails to cap output, but then Kuwait comes to the rescue. What happened here?
Well, a lot's been happening. In regards to Kuwait, it's much like the Verizon strike. You have employees, you have workers who want to get some respect, who want compensation and don't want their jobs to be cut or their compensation to be cut. When you think of Verizon as an example, as a parallel, you look at what's happening there. 91% of Verizon's profits come from Verizon Wireless, the non-union, non-striking workers. In a similar way, you've got with Kuwait, every country seems to be out there exporting oil at a time when demand is really low. So both sets of workers are looking at a paradigm where the world is changing and they need to find a way to adapt. In the case of Kuwaiti workers, those folks decided to negotiate with the government and stop it, which helped the markets in some way just because of regular order. But we're going to see more and more volatility in oil as we are seeing in the market.
So basically, Kuwait created this fear that there's going to be less oil on the market and therefore the oil's prices got propped up a little bit.
Well, the reality is there was less that was actually available to sell, and so the prices did prop up. You put in raw materials that have done well in the market just recently, and people think demand is up when it's really not.
Good point. All right, switching gears to tech. This week, IBM posted a 14-year low in quarterly sales. Intel announced layoffs, and Yahoo revenue took it on the chin. Is tech a soft spot in the market now?
Well, you know, when you look at the indices, the S&P 500, the Dow Jones Industrial Average, and NASDAQ, the three major indices, the NASDAQ representing tech is the one that's not approaching an all-time high. It's about 3% off of the high from last year. But considering IBM and Intel, a lot of folks call this gray tech, you know, tech that isn't really leading its vertical, that's not disrupting or changing the world. And when it comes to technology, that's typically what you're looking for. When it comes to Yahoo, they're just continuing to report falling earnings. And whether they're positioning themselves to be sold or positioning themselves to restructure yet again, they're really not relevant today in today's sector. Much like other sectors, and perhaps even more so, you look to technology to lead the world, to disrupt, and to be the future. And if you find companies in areas like that, then those are the ones I place my bets on.
Now tell us more about quarterly earnings season. Who else over or underperformed? Any big tests ahead?
Well, when you look at my favorite sector, the financial industry, they're not doing too badly. When you think of those, you think of JP Morgan, Bank of America, Goldman Sachs. But their results are more of a reaction from what the Fed has done and rates being so low, also reserve requirements from the Dodd-Frank Act. But don't cry too much for them. When they're in the money business, you typically find a way to make money, regardless of regulation, regardless of laws.
Jason, you know, we've talked about the fiduciary rule earlier this month when you were with us. It will require brokers who recommend investments for retirement savers to act as fiduciaries or trustees who put their clients' best interests first. Regulators have released more details. Bring us up to date.
Well, the devil is always in the details, and that is especially the case when it comes to the financial industry. I mean, this is 1,000 pages of a rule. It's pretty boring reading, but there are some highlights that folks should pay attention to, and one thing in particular that was lobbied for. There are 3 million accounts that will probably be opened up between now and next April when the rule is supposed to go in place. And how do I get that number? Well, for one, there are 10,000 people retiring every year, and you've got about 300 days until the rule goes in place. And so for 3 million more accounts, not only are the accounts today grandfathered in where there needs to be a duty of care or legal liability, all the accounts that are open today, 10,000, tomorrow 10 more thousand, and on, don't have to have the same fiduciary duty of care. And so I'd say to you, last week or a couple weeks ago I mentioned, listen, be very careful, ask these questions of your brokers. Are they fiduciary? Can they put that in writing? Today I'd just like to tell you, here's a warning that you can sort of consider for yourself. Do not open one of those 3 million accounts unless you know for sure that the advisor and or the account is a fiduciary.
And ask them, what's your commission? What are they charging you, right?
What are they charging you? Yeah. And what are all the fees you're paying? Because what they might be charging you may not be inclusive of all the fees in the account. The trading fees that will be there inherently, the custodial fees, there are just so many fees. They're buried, and like I said, the devil is always in the details. Ask, ask, ask.
Real quick before you go, our 401ks, even though we're not ready for retirement, a lot of people watching, but it's still important to follow the stock market.
Yes.
It was down in February. Things are looking pretty good. Things are still volatile, as you've mentioned, but what's your prediction for the spring, summer?
The spring, summer, you're still going to see a lot of volatility. We have one really great piece of good news for the summer, and that's the Olympic Games. And we're starting to see in the political sphere that the leading candidates are really leading far and ahead from their competitors. So as there becomes more normalcy in the Republican and Democratic primaries, and we actually know who those candidates are going to be, and we have the lovely Olympic summer, we will start to see people looking at really just interest rates as the remaining thing to see if we're going to have normalcy. And our markets will steady some, but I'll still say this is a time to expect volatility for the rest of this year. Hang on to your plan. Open your eyes now and again to look at that quarterly statement, but just be courageous.
Good points. Jason Howell, Family Wealth Advisor at Jason Howell Company. Thanks.
Thank you.